Alroy Lobo joins us. He represents Kotak Mah AMC. Alroy, good morning. Thank you for joining us. Alroy, after a 20% run-up in last 1 year, what are you advising your clients? Do you think, or what are you advising your fund managers? Let me rephrase it. Are you telling your fund managers that the risk-reward ratio is no longer favorable?
No, I think one has to take a little medium-term view on markets. Our sense is that the next 5 years for Indian equities is going to be pretty good. We are in the early stage of an economic recovery. Things can only get better from here onwards. Policy has clearly begun to surprise on the upside. And my sense is that if the reform progress continues, then you could see earnings upgrades coming into the market. In which case, you need to take valuations more with respect to what will be the earnings growth profile in the next few years. At the moment, I would say that we are still not overduly, overvalued. We are just about slightly above the middle range, which we have seen in the last few years. In which case, there's no need to be, bearish on markets. We have a very constructive view on markets going forward.
Alroy, you mentioned that from a 5-year perspective, things are looking quite charged up. But what about how are things looking from a 1-year perspective?
I think we are also constructive on the 1-year perspective. My sense is that one can look at least about 12 to 13% in upside, from current levels in rupee terms, which is quite good, given that we are just sort of getting out of a slowdown as far as the economy is concerned. My sense is that from there onwards, you could see, better returns for markets. By the end of this calendar year, you will perhaps see market even discounting what is FY15. And remember, next year we have an election year, so market will have some kind of uncertainty around the elections. But by and large, I think the momentum is now moving very positively. We do believe that 5.5% GDP growth rate, which we are forecasting for this fiscal, would be perhaps the bottom for the Indian economy. And our expectation is that you could see about 6.2 to 6.3% in the next fiscal year, which is fiscal 2014. But the trajectory clearly, is on the upside. And the government, is committed towards reducing fiscal deficit and goes as per plan. Then I think we have a very good story for global investors in India.
What are your high conviction themes at this point in time, Alroy, and purely in terms of value?
No, I would say that one has to take more of a risk-adjusted approach because many times we run after value, but there are a lot of value traps in the market. We are still staying away from infrastructure or power equipment plays in the market. We need to see far more on the investment policy or investment cycle. It's not yet enthusing. So even if while we are projecting a recovery, it's basically coming more from a rebound in terms of agriculture growth, and it's coming more from our expectation of a reduction in interest rates. So I would still say that even though some of these names in the infrastructure space or the construction space or the power equipment space look cheap, they deserve to be cheap in the absence of potential triggers. So we don't mind buying things slightly more expensive as long as we see a visibility of earnings growth. We see a return ratio which is having an upward trajectory. We see free cash flows which are strong and having an upward trajectory. So that's our broad framework, and I think it has held us in good times and bad times. We will continue with this philosophy going forward.
Do you think after the kind of numbers we've got from large cap IT companies, there is enough visibility in IT stocks? They are cheap, they have zero debt on their balance sheet, return on equity is strong, and margins have expanded?
No, I would say that we are still not convinced with a broad-based recovery in IT services. If you really go into granularity, our view very clearly is that there are still a lot of challenges as far as growth in 2013 is concerned on IT spend. We are waiting for Cognizant's commentary in February. I think it's February 7th. My sense is that their growth guidance for this calendar year will be lower than what they achieved last year, which itself is a very strong indicator that 2013 is not going to be as good as 2012. Remember, the IT sector now in India has become very large, and because of that, we are very much levered to the global cycles. So to some extent, the sector is becoming more cyclical in nature. The growth rates have shrunk to around 12 to 13%. Margins have basically, been declining over a period of time. The receivable cycle of this industry is clearly increasing. And my sense is that the cash sitting on balance sheet of companies, unless it is given back to shareholders, I see little potential for a very big trigger in IT. So I would say at this point of time, we are not convinced of a broad-based recovery. There could be company-specific, cases where one can get invested in. But by and large, we still want convincing data to say that there is a broad-based recovery in IT.
What's your call on energy, and which segment of energy are you more interested in right now?
See, I think the energy call is more event-based. I think the government's policy in terms of partial decontrol of diesel is very positive. We have seen initial reaction to stocks on the back of that announcement. What we are wanting to see is, that actually being played out in practice. I think if they're able to do that, then there's a lot of value in the, downstream and upstream energy companies. In the absence of, that trigger, we think that, there is a potential downside. So I think it's very much dependent on the continuance of this, reduction in oil subsidy, which will be a trigger for the stocks. Remember that energy stocks, they are cheap because of the subsidy issue. And also one has to take a call on what's going to happen to oil prices. At this point of time, in the absence of any, unusual event, our view is that oil prices should not really move up. But they're not likely to come down either. So the only trigger for these stocks is what happens on the subsidy issue. And therefore, the continuation of small doses of diesel price hikes are going to be important for unlocking the value in these companies.
Elroy, between debt problems in US and political problems in Europe, which event to your mind or which geography to your mind will have a greater influence on world economy for 2013?
I would say that, by and large, we're not expecting a global crisis. So to that extent, while there are events that will unfold both in the US and Europe, the fact of the matter is that nobody wants these markets to fail and nobody wants to create a global crisis. So at best, you're going to see sluggish growth. In our opinion, as far as Europe is concerned, you could see, a contraction in the economy, or at best, a flat economy. As far as US is concerned, because of fiscal cliff issues, there's bound to be, an increase in taxation and spending cuts, which will bring down, growth rates for the US. So while we are looking at these kind of events unfolding, we don't think there's going to be a global crisis, and that's our base case.
From the budget, Elroy, given that that's going to be the key trigger near term for our market, what do you think can make or break market sentiment?
No, I think what all of us will be looking forward to is a more credible plan as far as the government's fiscal deficit roadmap is concerned. It has to be structural. It can't be coming from one-offs. It has to be, driven by policies which will continue, particularly on reduction of subsidy. I think the world is watching. The international rating agencies are watching. They want to see credibility in that fiscal roadmap. And if we're able to come out with a very credible, implementation plan, and we, live up to the word, then I think we have a very good story. There's a potential for fiscal deficit to kind of contract. The finance minister is very committed in keeping the fiscal deficit at 5.3% of GDP for this fiscal. Most of the consensus estimates in the market are in a region of around 5.7 to 5.8%. So we'll need to see what is really, causing this reduction in fiscal deficit that the finance minister is targeting. My sense it would come from, expenditure cuts. And next year, what is the fiscal deficit target, and is there a credible, roadmap in achieving it? And I think if we're able to, convince, the world in terms of this roadmap, then at least the tail risk of a rating downgrade by international agencies is clearly out of the way, and you could see a potential re-rating of markets.
All right, Elroy, appreciate your time and thank you for joining us.